Wise investors, welcome back. This is Brian from CrowdWise. Today, we're kicking off the Level 3 investor courses where we're going to be talking about screening and selecting early stage deals in crowdfunding. Today, the first lesson, we'll talk about how to spot a good early stage deal. We'll take some lessons from 6 professional investors or otherwise professionals, and then we'll talk about creating your deal funnel. An overview of what we're going to cover today. We'll talk about how to create your deal funnel and what that is. What makes a good investment opportunity? And for that, we'll be looking for some words of wisdom from 6 professionals. Howard Marks, who will talk about value, Jason Calacanis, who talks about how ideas have to look crazy and also the importance of founders in early stage investments, Peter Thiel, who talks about upside potential as well as businesses working on problems that are under the radar, so to speak, Paul Graham, founder of Y Combinator, who talks about intuition, Marc Andreessen talks about how ideas must be weird and unusual. And then finally, we'll talk about refining your process in deal funnel. And for that, we'll go to a quote from Annie Duke from her book, Thinking in Bets. Lastly, we'll talk about resources for initial deal screens for crowdfunding investors. So, how do investors choose what to invest in? There's a sea of startups out there that are all looking for capital. Today, there are dozens of these startups raising on equity crowdfunding portals, such as WeFunder, StartEngine, and others. So, out of the whole sea of startups, how do you down-select to the 1 or 2 that you'll actually pull out your wallet for and invest in? That's what we're going to be addressing today. It's easiest to think about the selection process in terms of a funnel. At the top, the funnel is wide, and then as you bring it through your screening process, you will down-select to just the few investments that you end up investing in. At the top of the funnel, I've heard it referred to as don't diligence. This is where it's just as important to make sure that you're not bringing some of those startups into the funnel that shouldn't be there in the first place. Once you enter the top of the funnel, you're going to be filtering for good potential investments that align with your goals. And that's what we're going to be talking about today. Then, moving on to the next level of filtering, you have the due diligence and valuation phase. This is what we'll be covering in lessons 2 and 3. Finally, you have your allocation and your investment decision at the bottom of the funnel, where only a few deals will make it that far. With crowdfunding, compared to angel investing, there is one key difference in this funnel, and that's that the deals that are entering the funnel, also known as your deal flow, is very different. For angel investors, they have to work very hard on developing their deal flow, especially when starting out. However, for crowdfunding investors, we have both a blessing and a curse, and that all deal flow is equal for investors. This is because once a deal is posted to a crowdfunding portal, it is available for any crowdfunding investor to invest in, as long as you invest soon enough before it sells out. We're going to be spending more time on creating this don't diligence filter, which prevents those deals from entering the funnel that shouldn't be there in the first place. So let's turn to 6 experts now and see what they think makes a, quote, good investment. Howard Marks, one of the co-founders at Oak Tree Capital, has a lot of good quotes, some of them taken from his books and also his investing memos. First, Howard Marks says, to achieve superior investment results, your insight into value has to be superior. Thus, you must learn things others don't, see things differently, or do a better job of analyzing them. Ideally, all 3. Furthermore, in his book, Mastering the Market Cycle, Howard Marks goes on to say, it's not what you buy that determines your results, it's what you pay for it. And what you pay, the security's price and its relationship to intrinsic value, is determined by investor psychology and the resulting behavior. Now, Howard Marks isn't necessarily known for being a prominent early-stage investor. However, as we'll see, these concepts on value also can be very important when applying it to early-stage investing. Let's look at an example. One that many are probably familiar with is Uber. If you get a second, pause the lecture and head over to this link to take a look at Uber's first pitch deck ever. At the time, they were called Uber Cab. As you look through the slides, ask yourself, was this necessarily a no-brainer investment? Well, hindsight can seem to be 20/20 in looking back, but let's look at what some famous investors at the time did. First, Mark Cuban said no at a $5 million valuation. Keep in mind that, depending where the stock is at today, they're trading somewhere in the $60 billion plus range. He was quoted to say, this is high risk, medium reward, and furthermore, that he wouldn't touch a $2 million valuation, let alone $5. This goes to show that even the experts can have a tough time spotting deals. Furthermore, it goes to show that in early stage investments, nothing is a sure bet at the time. If you look at Uber's 2010 seed round at a 5.4 million post-money valuation, it was a 3.8 million pre-money, you'll see that 150 of 165 AngelList investors didn't even respond to the email. Furthermore, only 4 out of about 20 investors invested when Travis presented to an Open Angel Forum meeting where he was introduced by the famed investor Jason Calacanis. This just goes to show that hindsight can appear to be 20/20. When looking back at history, Uber may have seemed like a no-brainer. However, it's important to remember that the outcome was still probabilistic. This means that while it did turn out to be a success, there are a lot of different choices and obstacles along the way that could have easily ruined Uber's outcome. Let's go to one of those early stage investors in Uber, Jason Calacanis, for some of his words of wisdom. First, he says, if these businesses didn't look completely crazy, then everyone would want to invest in them, and there would be no need for angels. Jason also had the opportunity of investing in Twitter, but had decided to pass on it. In reflecting on why he passed on Twitter, he says, it was at that point I realized that I didn't need to know if the idea would be successful. I only needed to know if the person would be. He's touching on 2 key factors here for early stage investors. First, that the real successful investments may look crazy or even sound stupid or counterintuitive at the beginning. Otherwise, everyone would be investing in them. And we saw how this actually played out with a company like Uber. Second, he talks about the importance of founders and the founding team. To summarize this, he's saying that an A team with a B product will outperform that B team with an A product every time. Moving on, Peter Thiel, one of the co-founders at PayPal, Palantir, and one of the early investors in Facebook, has to say this about upside potential in early stage investments. He says the biggest secret of venture capital is that the best investment in a successful fund equals or outperforms the entire rest of the fund combined. This implies 2 strange rules for VC. First, only invest in the companies that have the potential to return the value of the entire fund. This leads to rule number 2. Because rule number 1 is so restrictive, there can't be any other rules. I like to refer to this as the Fight Club rule of VC investing. In the movie Fight Club, the first rule of Fight Club is that you don't talk about Fight Club. The second rule of Fight Club is you don't talk about Fight Club. In a similar fashion, the first rule of VC is that you can only invest in those companies that have the potential to have a huge upside. And because of that, this is the only rule that matters. Now, Peter Thiel also mentions that the best projects are likely to be overlooked, not trumpeted by a crowd. The best problems to work on are often the ones nobody else even tries to solve. Again, he's hinting at some of this counterintuitiveness and the craziness of some of those best ideas. Now, for crowdfunding investors, you may not necessarily have to invest in a company that's a $1 billion potential if you're investing at very low valuations at, say, 3 to 5 million or even 10. However, you still need to make sure that there's, for example, 100 million valuation potential at some point in the future if you want to get a good return on your investment. Let's move on to another co-founder of a very popular seed accelerator called Y Combinator. This is Paul Graham. He has this to say about intuition. That's the thing about counterintuitive ideas. They contradict your intuitions, so they seem wrong. One of the best examples of this is a Y Combinator alum that you've probably heard of, Airbnb. Back in 2008, the CEO, Brian Chesky, was trying to raise a seed round. He was looking for just $150,000 at a $1.5 million valuation, which was him basically selling 10% equity. Out of 7 prominent Silicon Valley VCs, only 5 responded, and every single one of those turned Chesky down. A lot of their concerns were who would want to sleep in a stranger's bed? Who would trust strangers in their house? Again, we know when looking back that all of this ended up working out for Airbnb. But at the time that the investment was being pitched, there was a lot of uncertainty, and many investors and people couldn't grasp how this would become a new way to book lodging. Lastly, let's look at another famous venture capital investor, Marc Andreessen. He says, most of the big breakthrough technologies and companies seem crazy at first. PCs, the internet, Bitcoin, Airbnb, Uber, 140 characters. It has to be a radical product. It has to be something where when people look at it, at first they say, I don't get it. I don't understand it. I think it's too weird. I think it's too unusual. Here, Marc is touching again upon the same wisdom that we've heard from some of the other investors, that it can't appear to be a slam dunk from the very start, and often people will think that it won't be. Now, another way of visualizing this is something that's a 2x2 venture capital matrix that Andreessen uses. On one axis, we have success and failure, and on the second axis, we have consensus and non-consensus. Marc Andreessen believes that any investment can be any combination of these two axes. So, starting in the lower left, you have your poser venture capital firms. These are the lemmings that all pile into the next great deal, AI, blockchain, virtual reality, all those things that are the hot words that you hear of today. However, because everyone's piling into those, you're probably not getting a great value. And furthermore, many of them are going to end up being failures. Now, moving up in the same quadrant of consensus, but successful investments, you have today your index funds and ETFs. These are things that everyone knows are successful if you're a passive investor and hold them in the long run, and so they can result in moderate success. Now, one important thing to note is that just because something is in a certain quadrant today doesn't mean it will stay there. In fact, once something becomes such a consensus that everyone is doing it, it's likely that most of the advantage of investing in that has been lost. Now, moving to the second quadrant of non-consensus in the bottom, we can see that non-consensus failures are a necessary part of success for top venture capital firms. We talked about this in our Swinging for the Fences, or the Power Law Investing lecture, where some of those strikeouts are necessary in order to hit your home runs. But moving up, and the quadrant that every investor should strive to be in, is the non-consensus success quadrant. This is where you get above market returns for top VCs and value investors. Now, the reason why you want to be in this non-consensus quadrant is because it's only in this non-consensus quadrant where optionality is mispriced. We're not going to be talking about what optionality is or making you an expert here, but for a great book on the topic, check out a copy of Nassim Taleb's book, Anti-Fragile. So, one of the important things we mentioned is that what works today won't necessarily work tomorrow or next week. This is why it's crucially important that investors are continually improving your funnel. Use the lessons that we've talked about in the prior courses, such as creating an investment decision log and running through checklists. This is where you're using objective criteria to make sure that you're making informed decisions and then can improve those criteria over time. Writing deal memos, which is forcing you to put your thoughts down in writing on a certain deal so that you can go back and reflect on your thinking objectively at some point in the future. And also to understand that outcomes depend on luck as well as skill. For this, we'll go to a lesson from Annie Duke in her book, Thinking in Bets. Annie says, thinking in bets starts with recognizing that there are exactly two things that determine how our lives, or in this case, our investments, turn out. It is the quality of our decisions and luck. Learning to recognize the difference between the two is what thinking in bets is all about. To summarize this, just think that a good investment process can result in bad outcomes, and a bad process can still result in good outcomes. The most important thing is to recognize how luck is contributing to your outcomes so that you don't get fooled into thinking that luck is actually your skill. So, what are some initial screening resources that investors can use? When we look at our funnel and what goes in at the top, some of the resources to help you get to level 1 of your screening filter include funding portals. This is where all the deals are posted, so you can browse the various deals, look at their funding progress and how successful they've been with the crowd, and do more research that way. You can use rating services as well, such as King's Crowd, which, full disclaimer, I am both an investor in and a paying customer for. But let me take a second and explain why. Currently, the King's Crowd service is $10 a month. Now, I don't know about you, but what do you value 1 hour of your time at? For example, what do you get paid at your job? Is it maybe $20, $30, $40, even $50 an hour? King's Crowd, for $10 a month, gives you access to numerous deals where they spend hours and hours of due diligence on each one. Thus, it shouldn't be a replacement for your due diligence or screening process, but it is a great supplement and a multiplier to be able to give you back some of your time. Also, Neil Patel has something that's called the Angels and Entrepreneurs Network. Now, I haven't used this personally, but this just goes to show that there are other rating services out there for helping you look at your initial screening. Second, there are aggregation websites that look across all the funding portals and gather the deal data in one place, such as King's Crowd again, through their acquisition of Crowdits, and then startupbenchmark.com, crowdlustro.com, and many others. Also, something that I actually use are various forms of media, such as podcasts and TV shows. In terms of TV shows, Meet the Drapers, which is run by the funding portal of Republic, has some venture capitalists and angels, the Drapers, that interview founders and is a great way to look at some initial screening, as well as Shark Tank. Believe it or not, you can actually learn a lot from listening to the questions of the investors on Shark Tank. And furthermore, there have been numerous companies that are raising on equity crowdfunding portals that I've actually seen go through on Shark Tank first. Thus, it doesn't hurt to see what those professional investors had to say before you decide to make your own investment decision. Also, in terms of podcasts, there are many resources. There's The Pitch, put on by Gimlet Media, which again has had numerous businesses give their pitch to the venture capitalists and angels and then go on to raise on equity crowdfunding portals that I've seen. This Week in Startups and the Angel podcast, both put on by Jason Calacanis, that investor in Uber, and WeFunder's new podcast, Adventure Capital. All these resources and more are great ways to both start your initial screening process and also assist in due diligence. It's common knowledge that there's only one thing in this world that money can't buy, and that's more time. Thus, you should make sure that you're absolutely optimizing your time as a crowdfunding investor. When starting out, as we mentioned, there are dozens, if not even hundreds soon, of startups out there for your potential investments. So how do you optimize your time and make sure you're not wasting time doing due diligence on businesses that should never even be entering your funnel? That's the importance of crossing out a number of these right off the top so that you can make sure that you only spend precious due diligence time on the ones that are actual fits for your portfolio. That's why it's important to quickly eliminate deals that are showstoppers. I've also heard this sometimes referred to as the don't diligence funnel before you get to due diligence. For example, ask questions such as, what is the minimum investment? Sometimes if it's $1,000 or even $2,000 and you're aiming for your portfolio, as we calculated in past lessons, for something in the $250 to $500 range per investment, then you know right off the bat, whether or not it's an amazing investment, it's probably not a good fit for your portfolio. Also, look at the deal terms. Is it an equity or debt offering? If you're a for-profit investor, you probably want to be avoiding those debt offerings that have caps and thus limited upside potential. Also, does it align with your personal investment objectives? Perhaps you prefer to invest at a certain stage or valuation range that you're familiar with, or if you're a for-profit versus, say, a social benefit or other reason investor. All these types of things can very quickly help you eliminate businesses that don't belong in your portfolio and help you save time to only do due diligence on those investments that do belong. Only then, after you've done some of these initial quick eliminations, should a potential investment enter your funnel. Everyone is strapped for time these days, and so you want to make sure you're spending yours in the most optimal way. To help with this, we're offering our free deal funnel checklist to help you get started. It will walk through each of the stages and various questions that you might want to start with. Now remember, this deal funnel checklist should look different for every investor. However, we'll give some important guiding and starting points, such as what types of companies should never even enter your deal funnel, what you should look for at each stage, example questions to ask at each level, and what potential red flags and showstoppers are. To get your free checklist, just create an account, crowdwise.org/register, or if you're already a member, just log in. Then click the Members Only page under your account dropdown to download your free deal funnel checklists. Once you log into your account, you'll see the dropdown for the Members Only area right under your name in the top right. So let's recap what we've talked about for initial deal screening and equity crowdfunding. First, you must be looking for a non-consensus view, and it has to be successful. But remember that failure is going to be part of the process. Now with crowdfunding, this doesn't necessarily mean that you're going to want to invest in the campaign that's only raised $10,000 out of $1 million goal versus $1 million out of $1 million. It may be a good indication of potential success if that campaign can reach their maximum more quickly and has a wide base of numerous investors. In this case, some of that non-consensus view may be the fact that you're investing in equity crowdfunding at all versus a public market investor who doesn't think that the potential returns can compensate for the risk. Thus, non-consensus view can be looked at in a lot of different ways. Maybe you're investing in a non-traditional founder, a non-traditional business model, or other things like that. Do leverage that power of the crowd during your due diligence. Second, understand that early ideas may look crazy or even sound stupid. Third, look for rock star founders. As we saw from many of the experts, founders are often one of the most important things when investing in early stage businesses. And just go back to remember that A team with a B product will outperform that B team with an A product every single time. Also, remember that your investment opportunities must have unlimited upside potential. So think of investing in equity versus something like debt, which is capped in the upside. This doesn't mean that you'll easily be able to see how a company could become huge. Going back to the example of Uber, called Uber Cab at the time, they were starting to compete at the high-end luxury end of the market against limousines for executive transport in cities like San Francisco. They weren't even pitching that they'd eventually go out to the mass market. That's why it can be very important to have a rock star founder who can pivot along the way. Another example of this, going back, is Twitter, which started out as actually a podcasting service, and the 140-character project was just a side project. However, their amazing founders saw the potential and pivoted to their 140-character product as the main product of Twitter. What I'm basically saying is that you're not going to be able to see and understand everything, and even the founders may not know some of the future potential of their product. However, if you're investing in something that's, say, a local business where the founder has no intention of ever expanding or growing, then you may consider what the upside potential will be. So, next lesson. After you've found a deal that passes these initial screens, how do you perform due diligence? We'll be discussing what is due diligence and why it's important for investors, how much time investors should spend on due diligence, especially in how that compares crowdfunding versus angel investing or venture capital, the importance of your gut, that is to say your instincts, versus logic, such as using checklists, and then we'll talk about some due diligence resources for crowdfunding investors. As a reminder, you're part of the Level 3 Advanced courses right now in Module 1. We also have Level 1 Novice and Level 2 Intermediate courses, so if you haven't already, sign up for your free account at academy.crowdwise.org for the best learning experience and for access to all the investor resources. Thank you again, everyone, for tuning in to this lesson. We'll see you back here for Lesson 2, and if you haven't already, follow us on social and subscribe to our YouTube channel at the link below so that you can get all these latest investor courses and other updates from CrowdWise as soon as they go live.